corporate news is pretty thin on the ground in the coming week, barring trading updates from Sainsbury, Victrex and full year results from Baltic Classifieds. So the top-down data may take over the headlines. On this side of the Atlantic, well, that probably means the result of the 4th of July's general election, and that's likely to dominate, while on the other side of the pond, Independence Day celebrations on the very same day may distract more than a few Americans. However, there are also some data sets due out from the States in the coming few days that will be very important, and they will focus primarily on jobs. And that's important because employment is one of the US Federal Reserve's twin mandates, alongside inflation, and stock and bond markets are still in thrall to central banks. So, back we go to discussing those policymakers, whether you think they're all powerful or whether you think they're just as prone to error as the rest of us. Markets' current thinking is that any sign of weakness in the American jobs market could prod the US Federal Reserve to making that long-awaited first cut in US interest rates from the 5.5% level that was reached last summer. That in turn will be seen as a move to boost US growth by making credit cheaper and easing the pressure on American government finances in the process, and also to the benefit of company earnings thanks to higher demand and lower interest bills. The theory is also that lower returns on cash and lower bond yields may persuade investors to seek a higher return in different, albeit riskier asset classes, including equities. Now, there's no guarantee that this script plays out, even if it's consensus thinking. US equities are already trading at or near record highs, at least based on some indices, so additional profits growth and cheaper money are already priced in, at least to some degree. Moreover, markets began 2024 expecting 6 one-quarter point rate cuts from the Fed, with the first one in March. But stubborn inflation and a strong jobs market have prompted some backpedaling, to the point whereby consensus is now looking for just 2 cuts down to 5% by Christmas, and the first one is due in September, according to the very useful online CME FedWatch service. Nevertheless, markets continue to watch the Fed's every single move, and in turn, the big data releases which may influence the thinking of Chair Jay Powell and his colleagues on the Federal Open Markets Committee. They'll be looking to this data to see if something's happening that may trigger the elusive first cut. Now, the first piece of data is the monthly Job Openings and Labour Turnover Survey, or JOLTS, and that's due on Tuesday the 2nd of July. April's reading showed 8.1 million job vacancies in America, but that was way down from the 12.2 million peak of 2 years ago and almost back to the pre-pandemic level. To some, that suggests the American economy is slackening. To others, the number of vacancies is still historically high. This is a data set with a pretty short history. It goes back to 2000, and the Fed, as we can see, has tended to cut as vacancy numbers recede. Then, after the private ADP payroll survey and the Challenger Gray and Christmas job cut study on the 3rd of July, come the main batch of jobs data on Friday the 5th, the official government survey of job additions, plus the unemployment rate and wage growth. America added 272,000 jobs or payrolls in May, so that's the benchmark for the June figure, and watch out for any revisions to the historic data. Downward changes to preliminary estimates tend to portend of a slowdown or recession, which could mean interest rate cuts, and upward changes are generally seen as indicative of ongoing economic strength, maybe interest rates staying where they are. Attention will then switch to the headline unemployment rate. This is creeping up and now stands at 4%, compared to 2023's trough of 3.4%. However, again, it's a historically low figure, although the Fed did cut when the jobless rate was around the 4% mark in 2001 and 2020, although it did do so in response then, the collapse of the technology stock market bubble and the pandemic respectively. A rapid rise in unemployment has tended to prompt Fed rate cuts, not least because it weighs on wage growth, and wage growth can fuel as well as respond to inflation. US wage growth is cooler than it was too, at 4% year on year, but that's still twice the Fed's 2% inflation target, so policymakers will watch out for this figure as well. At 5.5%, the Fed funds rate is now well above the consumer price inflation rate of 3.3%, and that state of affairs helped to prompt rate cuts in 2007 to 2009, although then the Fed's main focus was the wider fallout from the great financial crisis. So as we can tell, therefore, no trigger for cooling inflation or rising joblessness has ever quite been the same, so history cannot be investors' only guide. If anything, Seasoned Fed watchers may let the financial markets do the work for them and use those as a guide to when the US central bank may act. And the 2-year US Treasury yield has an uncanny habit of moving 6 to 9 months before the Fed does. Right now, it stands at 4.82% to price in 3 cuts in the next 24 months and, in effect, decent economic growth and slightly sticky inflation. If the macro scenario deviates from that, then we may see more decisive Fed action one way or the other. I hope that you and your families are all keeping well. Thank you for watching, and I look forward to seeing you again next time.